Mines and Money Online Connect. My name is Michael McRae, Mining Audiences and Data Intelligence Manager with KITCO News. You are watching the Gold Panel. Is gold the best surefire investment for both natural resources, fund managers, and generalist fund managers alike? If so, what's the best place to invest? Is that gold producers? Is that juniors, ETF, or bullion? We have a terrific panel to help us with all of these questions. We have Adrian Day, Chief Executive Officer at Adrian Day Asset Management. We have Mark Burridge, Managing Partner and Director, Baker Steel Capital Managers. We have Keith Spence, President, Global Mining Capital Corporation. Shayne McGuire, Portfolio Manager, Emerging Markets and Gold Fund, Teacher Retirement Systems of Texas. Ruth Crowell, Chief Executive, LBMA, and Robert Cohen of Dynamic Funds. I'm going to talk this one to you first, Adrian. How would you gauge the level of interest in the gold sector by the generalist right now?
Obviously this year it's been remarkably strong, and it's been a resurgence of interest from generalists, I think, that has really driven gold so far this year. As we all know, generalists have been either, for the most part, with very few exceptions, out of the gold market for the last 10, 15 years. It's then coming back in, even in small amounts, that has really driven the gold market. And we're seeing this, of course, with everything from Warren Buffett buying gold, which you're going to talk about later, as well as individual retailers. And the interesting thing for me, my audience is very much retail. So our average account size, for example, is about $750,000. And we also have a fund. So we're very much retail, because that's the average. Obviously, a lot of people are smaller. What's interesting to me is we're getting people coming in who want gold, who haven't looked at gold for maybe 10 or even 20 years. And what's really interesting to me is how the conversation goes. In the past, I would have people call and say, hey, my buddy told me you were up, 92% last year. Is that true? Well, yes, but that was last year. Well, I want some of that. I want it. We're not getting that anymore. What we're getting now is the Federal Reserve is doing this, central banks are doing that, the world's a scary place, I don't trust the dollar, I want to buy gold. Do you know nobody this year has asked me, what was your performance last year? Nobody. They're not buying gold on performance, which I think is a very positive thing, frankly. But anyway, no, the level from, now, having said all that, let's just recognize that we have seen a little bit of a topping. Last August, the numbers came out last night. August flows into ETFs were the smallest this year. Smallest since January. And by a fairly significant amount. I think we had something globally, someone correct me if I'm wrong, something like $1 million, a million ounces rather, flow into gold last year. And that's down from an average this year of 3.5 million a month, 3.5 million ounces a month. So a significant slowing, but we can talk about that later. But I don't see that as a big concern in the long term, frankly, just a temporary slowdown.
Anyone else on generalist interest?
Hi, Michael. Ruth Crowell here from LBMA. I think from our side, just to contrast with what Adrian's saying, we're definitely the wholesale side of the market. So we look after local London, it's bilateral or over the counter. And I think there's two main ways we've seen the interest in gold go up. One is very simply the trading numbers. We've gone from an average daily volume of 45 billion US dollars a day to 65 billion US dollars a day. And that's also reflected in terms of stocks held in the vaults. The other aspect has just been newcomers' interest in terms of the market, and that's been flooding in even before COVID to some extent, because we'll talk about this later, I'm sure. The bull market was starting well and truly into the beginning of 2020 already. It's taken up pace as we've hit COVID, but certainly the newcomer interest has been growing as the pandemic has spread. And I think as part of our response to that is we've also announced we've got the record holdings of gold in London today of 555 billion US dollars. And you're getting that information 3 months sooner than you were previously. So the interest has been overwhelming, and I'm sure it's the case for the colleagues on the panel as well.
Yes. Ruth, thank you very much for the news. Go ahead, Mark.
Yes, Mark. Yeah, I mean, I think we're seeing definitely a pickup in interest. You know, we cater to the generalist investor in our funds who want to invest in gold or through the gold miners, and there's been a pickup. But what's interesting is that it really is a lot of people returning to gold or increasing their gold weightings. And we hear about not just what they're doing on the gold equities, but what they're doing in terms of their physical metal holdings. So what we're seeing is people who might have been involved in gold before are coming back to the sector, as you said, Adrian, 15, 20 years later. And there's a smattering of newcomers, funds who might have never touched the sector before looking at it. But really, in terms of, you know, the broad mass of generalists, in terms of, I still think we're perhaps only at the very beginnings of that generalist interest coming back into the sector. I mean, I think if, you know, I don't know how everybody else's experience, but if I walk down the street and spoke to my neighbors, and I do, you know, socially distanced 2 meters away, speak to my neighbors, you know, they're talking about maybe buying Amazon stock, or, you know, a few months ago they were talking about buying toilet roll or whatever it was. But now, you know, they're still not, you know, I'm just starting to get the first few questions about, oh, shall I invest in gold now? I hear you're in gold. Well, I think before, maybe a couple of years ago, they thought maybe it's some kind of archaic barbarian investing in gold mining. They're only just starting to ask me that, and not ubiquitously either.
I think that would be, I think we should talk about kind of the watershed moment, and that was actually Warren Buffett adding GOLD to his portfolio, and that would be Barrick. I know from my own past interviews, you know, talking to the miners and the juniors, just saying that this investment has really been kind of a support for the sector of all. And then it's actually getting kind of the world's best investor actually taking finally an interest in gold after, would you say it's kind of labeling precious metal with some of its heaviest baggage, I would say, in terms of criticisms. Anybody else on Warren Buffett?
I can say something on that. Like, Warren Buffett traditionally would not touch gold because he would say, you know, blanket statement, like, it doesn't have any yield. There's no yield. I can't earn a yield on it. The concept of the gold price appreciation and protecting purchasing power of currency, the yield is therefore embedded in the gold price. But a lot of people cannot grasp that concept. But I think he finally came around to it. So I think that it is very much a landmark move to see him, who used to really criticize gold, to make a full 180, which is very impressive.
I'd like to say something, if I may. I think in the past, Buffett has derided gold, made fun of it, et cetera, as we know. But it's not the first time he's invested in precious metals. Some of you will recall that in the late 90s, he bought the equivalent of 20% of the year's production in silver. Tactically, I don't know how well he did on the trade. This is the late 90s. But going back to what he did just now, I think that for a number of portfolio managers, gold investment is becoming important, not just because of what's happening in the bond market where yields have collapsed, but also because simply because of the earnings boom that all these companies are having now. It's hard to ignore the impact, even if you thought they were just making screwdrivers. Well, if the price of screwdrivers is surging, you're going to be interested in the stock. So I think it was a matter of time before Buffett and others started becoming more attracted to gold at this point.
Can I add something to that, if I may? And I haven't heard that Buffett specifically has said this, but Buffett, of course, likes to invest in companies with a moat. And I think the thing about the gold mining companies right now, their moat is the lack of new discoveries, and particularly the lack of large new discoveries that we all know about. But if you like, that provides companies with a pipeline like Barrick. It provides them with a moat, because gold as you know, Shayne, I mean, obviously you know, is not like screwdrivers. We can't just boost the production because we want to. So yeah, I think it fits with the Buffett sort of traditional type of Buffett investment very well, in fact.
I think
also with the Barricks.
point that, sorry, Keith, go ahead.
Yeah, I was just going to say, well, everybody knows he is a value investor. And so one could argue he's seeing value in them there hills in gold. So basically he's saying there is a lot to go in terms of performance. Who knows? You know, he's buying gold at a level that he would consider is still undervalued.
And don't forget, he sold the banks to pay for the gold. So that's a statement in itself.
I think the other thing is not only does the sector present tremendous value and that sort of indirect hedge via gold bullion but I think there's a real potential for the sector to generate actual returns through dividends and buybacks that we haven't seen potentially in decades, because what we're seeing now is incredible margin expansion. I mean, some companies have already started paying out dividends and shareholder returns in excess of $600 for each ounce they're mining, and with several above 100 to 200, and that presents an enormous return opportunity for an investor who's looking for returns. And I think the sector right now is in a sweet spot. You've got discount to value, you've got returns and being paid through dividends and buybacks, and you have other things looking extremely risky at the same time, and a lot of support for gold, the metal. And I think that I don't know if we've seen this confluence of events in certainly 30 years I've been in the gold sector, and I think between us similar experience. It's quite incredible. And what surprises me is that he is just such a small position in the gold sector, given how attractive it's all looking.
Yes, and another key point is if you look at all the companies, the seniors, they're in ship shape. The good balance sheets. They've really fixed up themselves from a couple of years ago. When things were really, really bad. So you're looking at companies who are ready to move to the next stage.
I think we should, we've touched on it a couple of times, but we should just step back for a minute and then just kind of go through the panelists. And I'd just like to hear from everybody on what are the drivers for gold price? What do you think are the main reasons that it's going higher?
Guess I can start since it's quiet. I think, I think a lot of the fundamentals for gold, I think there's a lot of notion out there that it's supply demand. I keep getting asked by clients, what are the central banks doing, whatever. I try to steer them away from the supply demand fundamentals, because if I told you how many tons of gold's going here and going there, at the end of the day, it's all interesting data, but it's not going to give you the conclusion that you're looking for. You have to look at macroeconomic factors. So one thing, that single most important factor at this point in time is the real rate. So if you plot an inverted 10-year TIPS yield to the gold price, you'll see about a 94% correlation. So that's one variable that will really explain about 70-80% of the gold price movements. And then if you want to tighten up the model, you can add in other economic variables, such as a notion of what ME and QE is out there. So you can look at global liquidity. So I know one economist that will say, okay, I'm going to take the US monetary base, add in all the global foreign exchange reserves in the world, and correlate that to gold price movements. Again, a very high key stat. And that would be probably one of the most significant variables. You can look at things like the COMEX, but the COMEX is not the driver of the gold price. You got to ask yourself back to the original root. Why are people on the COMEX going more long gold? You have to look at those macroeconomic factors. So that's really more of a correlation, not a causation of what the gold prices. You would expect that if the macroeconomic environment is such that people will buy more gold. So then, of course, you will see that evidenced with, ETF demand and so forth. At other points in time, you'll see other macroeconomic factors or even political risk component be alive and well. Of course, political risk ebbs and flows. So anyway, those are a few of the variables.
Yeah,
Anyone else on?
I recently wrote a piece and I call it gold is firing on 6 cylinders, what I call the big six. If you go through number one, the flight to safety in this current environment, supply and demand. If you look at somebody just mentioned, which we haven't had a major discovery in the last decade or so. I mean, a substantial discovery in gold. So there's a limited supply. On the demand side, if any of you go to Hong Kong, it's almost impossible to find bullion. There's lots of people looking to buy. You have the Indians. It has moderated a bit, but there's a lot of feeling that post-COVID, there's going to be a lot of activity there. Then, if you look at the geopolitical issues, China, US trade, I spent a lot of time in China, and one of the things that I think is going to be even a bigger driver in the future. People forget that China has the largest foreign reserves in the world, 3 trillion, some say as high as 4 trillion. And most of that is in US dollar denominated instruments. And there is talk in the US that on both sides, the Democrats and the Republicans, that China is partially responsible for this pandemic. And so one could see, and there has been talk about reparations where China would have to pay for what it allegedly have done. And some people are saying, well, look, there's $3 trillion sitting there. Why not go after it? And so I've been telling my Chinese colleagues for years that a substantial portion of that US dollar denominated investment should be put into gold, or at least to protect themselves. And I could see the Chinese Politburo top brass seriously concerned about that 3 trillion and saying, maybe we should be buying gold. So I think that's another big leg that will likely pop, where the Chinese decide, we gotta go. Let's go, even though it's high, because they've been buying central banks, including the Chinese, but they only buy when things pull back. But now they might say, we don't care. Let's just go in and protect ourselves, because $3 trillion is a lot of money to be withheld from you. And there, of course, there's other reasons, but I'll let other people get a chance to speak.
Anyone else on gold drivers?
Let me
go ahead. I was just going to go in terms of, I think all the factors are definitely part of the story. I think for me, certainly the US dollar weakness is the big one. And I don't think it's a supply and demand issue in terms of the fundamentals coming out of Asia. I think it has much more to do with US dollar weakness, particularly if you look at when we hit 2000. This was a big jump in terms of US dollar terms, but if you contrast that to sterling or other currencies, we had already reached all-time highs in almost all other currencies, and the US dollar finally caught up to that. So I think it's US dollar weakness, and then the other major driver sort of looking forward is this professional investment coming in. So pension funds, others who are taking a more professional interest in the market, that is certainly having a big impact in terms of where gold's going now. Certainly, yes, there were profit taking when we hit 2000 as well, as you'd expect. I think it was a psychological number and once that barrier was broken. But I think we've sort of seen that recover now. Adrian, you were going to jump in, and
I agree with what you're saying about the dollar, and I agree also, of course, with what Keith was saying with all the various factors. But to me, all of these factors are really, or to a large extent, they're a reflection of the one fundamental issue, which is, as you said, the decline in the dollar, the destruction of currencies, the destruction of the value of money by the Federal Reserve and by central banks around the world. If you look at what the Federal Reserve is doing with QE4, QE infinity, I mean, the latest one, QE, I'm glad we've gone to infinity because there's nothing beyond that. With no red lines, with no limits, these are Jerome Powell's words, no red lines, no limits, with no thought at the moment about how they will ever normalize. Jerome Powell has said he doesn't think we will ever reduce the size of the Federal Reserve balance sheet. We will simply, at some point when appropriate, let it decline relative to the growth of the economy. So the Federal Reserve, in my view, has just lost control, absolutely lost control of the monetary situation in the US. You know, in 2011, Ben Bernanke was asked by Paul Ryan, remember Paul Ryan? He was someone who believed in balanced budgets, how quaint. And he was asked about, isn't this monetization of the debt? And Bernanke got all huffy and puffy, well, as huffy and puffy as Bernanke ever gets, and said, no. It's only monetization if it's permanent. What we're doing is just temporary. I mean, once we retreat, once we revert to normal, then that's not monetization of debt. Well, we've had 12 years or whatever of this. So when does temporary become permanent? And of course, not only has it not shrunk, it's continued to expand. I mean, the Fed in 2014 said they were going to normalize the balance sheet and normalize interest rates. 2014. And it was 2 years after that before they made their first tentative steps. Ruth, your picture's still there. I don't know why. So anyway, I think at root is the fact that the Federal Reserve has lost control, and people can see that they've lost control. It's not that people disagree with the policy. They can see that they have lost control. That's my view anyway.
And a corollary to what you're saying there, Adrian, is that interest rates are basically zero and negative interest rates. So, you know, the disadvantage of holding a non-interest bearing yellow metal is no longer an issue. So it's in fact an advantage. At least you have the capital appreciation prospects for gold.
If gold is, if gold is a safe haven, if gold is a contrarian investment, why are equities rising right now at the same time that gold is rising?
Well, fundamentally, it's a very simple answer is that, you know, equities represent profit margins of, or perceived profit margins of future mine or a mine, operating mine. And you get a leverage effect. So if gold goes up 1% and we're running things at probably a 50% margin, as you might be seeing these days, you're going to get a 2-to-1 leverage effect. So it's pretty simple math. Often the equities can actually lead the gold price. If gold price is sort of bound to go higher, you might see that more apparent in the equities in certain markets where it leads off, and then you're scratching your head, the gold price didn't move and equities are taking off. And then sure enough, gold price follows over the next day or two.
Anyone else?
I think perhaps you were thinking
Go ahead,
about,
Shayne.
Sorry. I think perhaps you were thinking, Michael, more about why general equities are going up. Why is the NASDAQ soaring to all-time highs alongside gold and gold equities? And that's the interesting question, right? If gold is a safe haven asset and tends to do much better than other assets when times are bad, why are they all both going up together? And I would say that it's basically along the lines of what Adrian was saying, that it's really an inflationary policy by central banks around the world, and they would say that openly, right? They are trying to increase inflation, and that's beneficial to general equities as well as gold equities. The big question is, what are the roadblocks for gold at this point? Perhaps, if you want to, I don't know if you ever want to jump into that, and what are the roadblocks for equities? And I would say that perhaps we were talking about the weakness of the dollar. That's perhaps one of the strongest drivers for gold this year. So if the dollar weakness is overextended and the dollar is about to bounce back, if albeit tactically perhaps, will gold hold its ground? And that will be the challenge for gold.
Anyone else?
I think it's quite interesting because it does come to the point that gold correlates or correlates randomly, or correlates differently to economic factors at different points, depending what's happening in the world, both macroeconomically and politically at any one point in time. So, it's perfectly reasonable that the same drivers that can create the stock markets to reach highs, as you pointed out, Shayne, can, because of their inflationary nature, also be supportive of gold. But we do see US dollar weakness is it can be strong for gold, but you do get times when gold and the dollar do move together. In fact, about a third of the time, that inverse correlation breaks down, and it's because gold, is driven by so many different things at different points in time. Ultimately, over history, gold's value is supported by wealth creation. That's counterintuitive to its role as a hedge against risk. So I think it's quite a complex thing. And what's interesting about where we are in gold with where central bank policy is going in sort of supporting inflation, we potentially have multiple phases of support for the gold market coming through right now. I mean, right now, we will discuss the reasons why people are buying gold and gold mining investments. But as we look forward to when inflation starts to kick in, I think many people would suggest that that's where we're heading. That again, traditionally has been very supportive for gold. But if the government policies that lead to that inflation, which is designed about resurrecting the global economy, leads to another phase of wealth creation, as it did in the last gold boom cycle, then that's also supportive for gold. So I think what you're seeing is a multitude of drivers, and each of them becoming dominant at different points in time. I agree, Robert, that low real interest rates is sort of a number one, and more than half the time that's sort of the key driver, makes up for more than half of it. But don't forget, low real interest rates are driven by two sides of the equation, nominal rates and inflation, and those both behave differently at different points in time. And at those points in time, some other factors can take over as well.
That's right, Mark. And I'll just add one more comment. It's just that a dollar isn't always a dollar. And even though S&P earnings are going up, the purchasing power of those earnings has fallen. So it's a bit of smoke and mirrors that people believe that they're earning more money, but then you have to go back and say the purchasing power has fallen. And what holds purchasing power is gold. So therefore, you can have this environment where you have both going up at the same time.
Does the panel want to wade into what the contours of this rise in the gold price might be, or how long it will last and where it will settle? You have the CEO of Barrick Gold, Mark Bristow, talking about looking to when gold settles at its new level. And, we have seen these spikes before off of the 2008 financial crisis when gold did take its run and then settling afterwards. How long, given the factors that we have right now, how long could gold continue to run, and where might it settle?
Start like the amount of debt in this world is incredible. If you take most of the G7 countries, and you take the amount of government debt plus consumer debt plus corporate debt, you're looking at numbers in excess of 250% of GDP. So the only way to get out of all this debt is to inflate your way out of it. And as long as that prospect is in place, I think that gold will just keep going up. It's going to obviously not go up in a straight line, as we all know from history. But, I think it's a very comforting place to store your wealth.
Ruth.
Yeah, Michael, I was just going to say, I think, we all talked about in terms of uncertain times, which we're certainly living in now. Gold plays an important role as acting as that reserve asset. So I think it's really challenging in terms of trying to say, when are we going to see sort of an end date to the bull run? This sort of thing, partly because there's so much uncertainty when it comes to first the virus, and then second, the economic impact that is a result of the virus. So I think as long as we continue to have that uncertainty, gold is going to continue to have an important role and it'll continue to grow. In terms of a guesstimation as to when we'll have a vaccine or return growth, I think my guess is as good as anybody's. Certainly some promising things out there, but I think we're a ways off. Is certainly.
Yeah, if you were thinking about a horizon, certainly a minimum of 3 years is not unreasonable to think that we have at least 3 years of plenty before the famine happens. And I would dare say maybe 5 years of plenty, because there are so many factors that has lined up a confluence of good. We haven't had these kinds of confluence of all these factors at the same time, that the momentum is so strong. There's nothing to pull back the gold price significantly. Consolidation at various levels and maybe at this level, but just as you look beyond the horizon, everything seems to be positive. So maybe at 3 to 5 years at least.
Keith, if we're in this time of plenty, let's look at the investment opportunities within the gold space itself. You have the juniors, you have the streamers, you have the producers, and there's also the metal itself. There's also ETFs as well. If you're an investor and then you're looking at it, how would you break apart these opportunities, and where would be the best place to expose yourself to the upside from the precious metal?
Well, I think from our perspective, we see those different types of investment. Although the bedrock for all of them is gold, as very different types of investment. I think physical gold is something that you own as a store of value, portfolio hedge, and it's you're holding it because its value doesn't change over long periods of time, and you can be very secure of it. Whereas if you're investing in a mining company, you're looking for other things. You're looking for growth, you're looking for returns, you're looking for leverage to that gold price. But different types of mining investments offer different opportunities on that theme. If you're investing in a larger established producer, that's very much you're looking at leverage, growth, and returns around that margin expansion around a healthy gold price. Whereas if you're investing in, let's say, a junior explorer, you're really much more investing in geology and management, because yes, the metal price can support those companies in making their dreams come true, but there's an element of geological luck and management skill to make those companies go well, and that's a very different type of investment. And all a good commodity price does is support them to increase their odds of making that dream come true. I think it's a very risky sector though, and you do need to have the opportunity to deselect the investments that don't make sense, which I think means that what we see is we plot this regularly, is that the ETF investments, while they do better than some fund managers, as a whole, they don't do as well as active management because of their inability to deselect, let's say, the more risky or troubled companies in the sector. So I think what we really see is that owning gold miners, and gold explorers are very different types of investment. All have great merits and great opportunities to make returns, but all have their pitfalls at the same time.
I think the seniors are going to continue to outperform. When a generalist comes into the market, he's looking for name brand, he's looking for Marbell, he's looking for or she is looking for the FANG equivalent in mining, and so therefore he's going to go for the Barrick, she's going to go for the Newmonts, maybe the Franco-Nevada, and the upper tier, mid-tier guys like, say, a Kinross, etc. So I think this boom is going to be a boom of seniors. The mid-tier and the juniors explorers traditionally do well at the end of the cycle, and I think they will do well. But I think if you're looking for massive movements, it's going to be the seniors, because they have limited risk in terms of the generalist perspective, and they're more predictable. They're well known. They don't want to dabble in Joe's Pizza exploration company. They want a relatively stable, big name. So I think it's the seniors have quite a bit to go again.
I agree with that completely. And, you know, what often happens in a gold bull market, of course, is that the seniors move first and they start to get too expensive. And then people start looking for the intermediates, the junior producers, and so on. At this point in time, the seniors plain are not that expensive. Mm-hmm. I mean, obviously value is more important than price. But somebody tell me why Barrick, even after the recent jump from Buffett buying it, why is Barrick at $29 today when it was $55 in 2011 or 10 or whatever?
Exactly.
What is the rationale? There's no rationale, and that applies to a lot of the companies. So I agree with you completely, but the seniors still have a lot of room to move. They're obviously the surest bet. I mean, Joe's Pizza exploration, whatever you called it, you know, might go up 100 to 1, but it might not. The surest bet is obviously with the big cap seniors at this point. And I'm a big proponent of juniors, by the way. I mean, our fund probably has more juniors in it than, well, I know Baker Steel has a lot, but we have more juniors exploration companies than most. But the surest bet is with the seniors. The other thing I would say that I think people need to recognize, we talked about the ETFs and we won't mention any particular names, but you know, they have done well this year, and they've probably done as well as most fund managers this year. That is unusual, I agree with you. Normally fund managers outperform. But the reason for that, I think, is at the beginning of a bull market, when you think about it, sometimes what I like to think of as the worst companies, the companies with the highest costs and with the highest debt levels, those companies clearly have the most leverage to a move in the price of gold. They're much more leverage than the companies with strong balance sheets and low cost of production. But without mentioning any names, obviously, to me, a bad company is a bad company. And so whether 6 months or a year, that effect of the leverage from the high cost, high indebted companies goes away pretty quickly. And so the ETFs include all of those companies, but a lot of fund managers don't really have a lot in their portfolio. I don't mean fund managers don't have leveraged companies, of course they do, but they don't have what I regard as bad companies with high debt and high costs.
Yeah, I think some good points there. Just quickly from a Baker Steel perspective, we don't invest in junior explorers. We have about 1% of our assets under management are in junior explorers. But I was making the broader point that there is merit in different types of investment, you know, for different types of investors to look at those companies. But I think the interesting thing about this theme that you mentioned about, let's say, you know, the lower quality companies suddenly sort of essentially being rescued by the gold price because they're suddenly generating the cash flow that they can fix their balance sheets and spend money, you know, on capital that they'd perhaps been cutting corners on before. I think the risk, you know, for those types of companies is that they do just that. They haven't been spending the capital they needed to spend on development or health and safety or environmental, and so their margin doesn't expand with the gold price because they suddenly find they're having to spend money on things or buy other assets to make their companies work. And, you know, so, you know, I think really when you're looking at those companies, you've got to look for the companies that are sort of holding that discipline line. You know, we're letting our margins expand. and that cash flow is going to be used that capital is going to be deployed in a very sensible way in terms of generating, real returns for investors, not making expensive acquisitions. Because that's, of course, what went wrong, last time round. And our sector's famous for, basically since the gold run of the early 2000s. I mean, the gold sector was in great shape in the late 1990s. Gold was at $300 an ounce, and all the companies were cutting costs and exercising capital discipline. So when gold price rose in the mid 2000s, margins expanded hugely. But then everybody started lowering their cutoff grades and increasing their gold price assumptions, and inflation was coming through at the time. And all of that was given away. And that's kind of like, I think coming back to the very first question about generalists, is why generalists moved away from the sector so recently, because these huge margins that they saw were going to come out of the rising gold price didn't materialize, and the sector got derated. I think maybe this time round it's different. And I think the majors and larger established companies are really so far holding some good discipline in terms of sticking with their conservative price assumptions and returning a heck of a lot of cash to investors in terms of returns. So, I think, you're dead right, Adrian, Keith, and Rob. I think you're going to make that point too, that there's so much return potential from the majors that it's actually quite an easy decision right now in terms of where to go in the gold sector. It will become more difficult as things move on and things become more fully priced, and then you're going to have to start looking at the next tier down to generate value.
I might add, that maybe my answer to this is not necessarily any part of the sector. The senior companies have had a history of value destruction, usually through bad acquisitions. This is why companies like Gold Corp don't really exist anymore. They got absorbed into Newmont for a song and a dance. So, just to say, well, go and buy the larger market cap companies is a magic bullet. Not really. Although I will say that, what I've noticed doing this for about almost 25 years is that you see ebbs and flows of management style. You'll see companies take on a lot of debt, then they get into trouble, then the new management team comes in. Oh yeah, we've learned from our mistakes from the past. We're not going to do that anymore. And they clean things up. And then they retire, another management team comes in, they make a mess of it again. And then we're back to the phase where you have companies like Barrick and Newmont going, okay, we're going to clean up the mistakes of the past, and here we go again. Not to say that they won't make those mistakes again in the future. So I think still in the mid-cap area, there's still a bit of some messiness there still. So while some of the leaders have vastly improved even in the last year, a lot of the mid-caps still have a lot of improvement to go. So then that leaves investors saying, maybe I might just go for a new project, a brand new exploration discovery or something different. So I think having a little bit of everything, like go and pick your best senior company, go and find your best mid-cap company, and then go and buy some of your best favorite exploration stories. Have a bit of diversification. I think a lot of investors, what I do notice, they go and gravitate toward royalty companies. I can tell you, if I was writing an academic paper to say why you should invest in a royalty company, I would not be able to justify the valuation, other than the fact that people just say, I'm going to go buy royalty companies and push the price higher. But, it's a bit of the emperor has no clothes. Maybe one day somebody wakes up and go, wait, these things are trading at 2-3+ times their underlying net asset value. So there's a lot of backfilling that would be required to ultimately justify the value of those share prices. So people say those are lower risk. And in a way, yes, because they are financial companies, they're not miners. But I prefer to either be in the miners or in gold bullion and just sort of skirt around a lot of these royalty companies. They're just too expensive.
And just on that royalty point, I've been saying for quite a while that there is only room for maybe 3 to 5 royalty companies. And of course, the big one, the Franco-Nevada, they have a huge royalty portfolio, but for the rest, most of the royalties that they pick up are royalties that a mine may never be built. And people forget that the principal risk for royalty companies is that the mine may never be ever built. and if there's no mine, there's no royalty, no coupons to clip. So in that space, I think that's one of the reasons why Franco is just acting like a FANG stock, because Franco is and of course maybe Royal Gold is just dominant in terms of the amount of quality royalties that are exactly a mine or will become a mine.
I see that we're getting close to the end of the panel. I did want to bring it out because it's an important factor if somebody is making an investment decision. And Mark, you touched on it briefly in your last topic, but let's talk about environmental social governance as being an important investment criteria, just understanding type of the risks, and then also a minor or a junior actually having good relations with the communities. How important is ESG and how might you measure it?
I think ESG is very important, and it's an important part of, regardless of the ethical points around it, which are very important to us. It's just simple risk management, and I think the mining companies have learnt this, and certainly most investors in the sector, like us on this call, have recognised it from a long time ago, that if companies don't do the right E, S, or G, the mine closes down, gets taken away from them, or cannot operate. And it's simple, and really the amount of money you have to spend to get ESG right is pocket change compared to the potential value of what's in the ground. So really, we feel there's no excuse for companies not to be starting to do the right things. And there are things that don't work out. I mean, we've seen examples of it happening to major companies. In fact, in some ways, some of the smaller companies, because they're perhaps a bit more nimble and closer to the operations from a management perspective, can sometimes manage those things better than the large corporates. And I think it's a couple of very good examples of large corporates doing some pretty bad things in the last few years.
Anyone else? You'll have to be quick.
Yeah, Michael, just to jump in, I think there's been a massive shift in terms of what was considered before a nice to have because it was the right thing to do. People have, and particularly investors, have recognized the risk in not addressing these in a meaningful way and what it means to the company on a whole. So I think investors are going to continue to demand information on how people are addressing those risks, and we'll see that trend continue.
Terrific. You have been watching the Gold Panel. You're at Mines and Money Online Connect. My name is Michael McRae, Mining Audiences Manager and Data Intelligence Manager with KITCO News. Robert, terrific. I would like to thank Adrian Day, Mark Burridge, Keith Spence, Shayne McGuire, Ruth Crowell for the last question. Robert Cohen, you have to introduce the last minute panelist there, please.
This is Cowboy.
Does he like
Cowboy,
gold?
we needed to hear from you on your outlook for the gold price and how long this bull market runs, but we'll have to do that next time.
He's part golden retriever, so there's your answer.
There we go.
Yes.
Thank you very much again, everybody. And I want to thank the organizers at Mines and Money Online Connect. We'll hold you off to the next event at the show. Thank you very much again, everybody.
Thank you,
Michael.